Generic competitive strategies.
Key thought leader, Michael Porter, 1980, George Day, 1990. Another Porter contribution to the industry-based theory of business strategy is the concept of generic strategies. 13 After analyzing and selecting industries, and leveraging and altering their structure accordingly, firms should choose one of three generic product strategies to obtain and maintain a sustainable competitive advantage: overall cost leadership, differentiation, or focus. Through an overall cost leadership strategy, the firm's competitive strength is based upon their ability to be the low-cost producer, subsequently underpricing the competition and enjoying higher relative returns. A low-cost producer leverages their high volume to effectively reduce the impact of all of the five competitive forces. However, a cost leadership strategy demands constant vigilance to maintaining operational efficiency and technological capabilities relative to the rest of the industry. A differentiation strategy can protect a firm from competitive forces by distinguishing their products from those of competitors. Products can be differentiated based on tangible attributes, quality, style, as well as intangible attributes, status, brand. Because customers will pay a premium for differentiated products, firms using a differentiation strategy may enjoy higher than average returns via a smaller relative market share. As industries mature, it may become more difficult to maintain unique differentiation. A third generic product strategy is to focus on a limited scope or segment of the market, intentionally pursuing low market share. Within that narrow segment, either a low-cost or differentiation strategy can then be applied, but with the recognition that this will not have an impact on the market as a whole. Porter emphasizes that firms will be more successful relative to other firms in their industry if they pursue just one of the three possible generic strategies, rather than diluting their organizational resources by targeting multiple generic strategies, an undesirable state Porter refers to as stuck in the middle. Another similar generic product strategy classification scheme was put forth by George Day, 14, whose typology can be envisioned as a 2x2 matrix that examines two dimensions of potential generic product strategies: price and quality. A firm with higher prices with higher quality, relative to other competitors, is considered to be using a premium strategy. Lower relative price, quality reflects an economy strategy. A superior value strategy results from a relatively lower price, higher quality combination, and an inferior value strategy reflects a relatively higher price/lower quality, for example, as might be seen in the case of a monopolistic environment, than competitors. Day's proposition is that the superior value strategy is the dominant alternative and should therefore be the strategy pursued by all. Limitations of generic product strategy models. Similar to the objections to the product market-based typologies, questions regarding the usefulness of the simplistic generic product strategy models have been issued. There may be more sophisticated contingent approaches to understanding and applying the generic strategies to be considered. For example, using Day's classification scheme, Brothers et al. Found that different product strategies work better in different institutional markets, and firms that match strategy with institutional factors will achieve better performance. 15. Taken as a whole, the industry-based views of business strategy may underemphasize the competitive advantages inherent in the firm's unique resources and internal capabilities, instead assuming a degree of homogeneity in firm resources. In the generalized industry-based strategic process, once an industry has been selected and entry strategy determined, it is assumed the firm can then acquire whatever additional resources may be required to compete in that industry. An assumption which the resource-based view, RBV, that follows has challenged.